Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm here to bring you the weekly economic review for the short week ending April 1st, 2021. So today, because of scheduling conflicts, our chief economist Clamagnac won't be able to join us. So I'll be taking you through the economic and the financial market sections. So this is already the end of the first quarter of this year. So let's recap the quarter. So on the right, the year-to-date figures. As you can see, very negative for bonds, very positive for equities. So let's start with bonds. The highlight of the quarter was rising interest rates, a long part of the curve. Of course, central banks are staying in place for the short end of the curve, but the 10-year plus rates have been rising a lot. So that means that for the long index, you're down minus 10.7% after 3 months, which is a very negative figure for that index in such a short time. The universe index minus 5% on the quarter and minus 3.5% for corp. So a quarter to forget for bond portfolios. Equities, the TSX so far leading the way, 8.05% in Canadian dollars. After that, you have the S&P 500 at 4.8%. You have EFI at 2.15. You have the Nasdaq at 1.5, and you have emerging markets at 1%. Emerging markets were much stronger than that for a part of the quarter, and they ended last year with a bang. So there was some profit taking there, but still positive returns year to date. Price of oil up by 22% so far this year, 1.3% higher for the Canadian dollar. Very positive move there. We were above 80 cents for a while, but now we've pulled back a little bit in the last few weeks. The euro is under pressure, minus 4% versus the US dollar, mainly because of diverging prospects on vaccination and on economic news this year. It's not that, well, they are having some issues with vaccination in Europe. It's much slower than everyone would want it to be. Economic data should be very good in euro, but not as good as in the US and in Canada. So this is hurting the prospects for the euro. And finally, the price of gold down 10% so far year to date. A higher US dollar is a headwind for the price of gold. So if we start with COVID, evolution of the pandemic, on the left, you see that the new cases are starting to rise again in the US and in Canada. Last night, we heard that where I'm based in Quebec City, that we will be having 10 days of lockdowns again to fight this third wave. In Ontario, we're hearing that it should be announced that there'll be 4 weeks of province-wide shutdowns. So we're still in there. In Europe, it's the same thing that we see. They're fighting the third waves with the third wave with lockdowns. But when you see Israel, the green line, it's interesting because this is where vaccination campaign is going the fastest. And as you can see, the new cases are dropping like a rock, close to zero now. So this is very interesting prospects for the rest of the world. Perspective on vaccine rollout on the right, you can see Canada now is at 12.6%, and we've jumped above everyone in Europe. Now we're only trailing the US, which is at twice the pace, but still we're doing pretty well compared to other countries in the G7. So positive news there, and we should see an acceleration in coming weeks and months as more and more vaccines come in. In China, beating expectations for the first time since last November. So here you have the PMI indices for manufacturing on the left, services or non-manufacturing on the right. Of course, the PMI is, just to repeat it, it's a survey that's done. They call businesses and they ask them how things are going. Are they going better? Are they the same, or are they worse than last month? And they build an index, meaning that when it's at 50, that means that on average things are stable. When you're above 50, that means you have growth. And when you're below 50, that means you have a contraction. As you can see, both the manufacturing and the non-manufacturing ones are picking up. And in fact, fact, it's the first time since last November that the growth is stronger than what was expected. So there's some momentum there, bodes very well for the global economic recovery of 2021. The Eurozone, here the economic surprises. This is an index from Citigroup. They look at the consensus forecast for all of the daily data that's being published. And when the data is above expectations, well, that's a positive surprise. And the stronger the surprise, the stronger the index will move. So now, as you can see, we are close to a peak surprise again. So for the third time we reached that peak since 2020. So there's some good momentum there for surprises in Europe, despite the race versus the variance and despite the confinement measures. In the US, the strongest contribution to global growth since 1999. Now you know that China is leading the pack for contribution to global growth, but there's so much stimulus in the US. And yesterday, Mr. Biden was in Pittsburgh announcing $2.3 trillion of investments over the next 10 years in infrastructure, so mostly repairing roads and bridges, also investing in broadband internet access and in R&D because China is getting bigger and better every year. So the US wants to keep up with China by investing more in R&D. So that means that the contribution from the US to global GDP in 2021 should be the highest it's been since 1999. So leading the way in 2021. And on the right, you have the PMIs, same measure that I explained for the China chart two slides ago. In the US, we are better than the average of the rest of the world, and it's even accelerating. So again, good strong signals here for the US, our main trading partner still. So if they're doing well, it helps us in Canada. And talking about Canada now, we had the GDP for January. It came in at 0.7% month over month. So if you annualize it, it's about multiplying by 12 gives you a good ballpark. So that's 8.4% pace at an annualized pace, so very strong. And we had the flash estimates for February, which is not available yet. We'll have in 1 month, and they estimated to be at 0.5%, so annualized close to 6%. So on the right, you see the V-shaped recovery continues, and to the 2020 cycle, as you can see, much faster than the other ones. But here it does include the 0.5% flash estimate from StatScan. Shows you how quickly this recovery is going, and we are expecting further gains in 2021. China-like figures also for Canada, so a very, very strong momentum now in the country. So financial markets. This week we had the largest margin call in history. So what's a margin call and what happened? Well, Archegos is a hedge fund which I had never heard about before. Probably neither had you. Last week, to make a long story short, in the markets there were some big names like CBS, Viacom that had strange movements in their names in their stocks. And during the weekend, we had in the new the finance media, they came out with articles explaining that it was the hedge fund that had lots of leverage. Archegos, we're talking about $10 billion of assets, but being invested for $40 to $50 billion of exposure. So that means a leverage ratio of 5. So they're borrowing from banks to invest in the markets. And it went well. It didn't go well, and they had to sell as an emergency some of their holdings because they had lost too much money, to repay the banks for the money that they had borrowed. So this is a margin call. As you can see on the chart on the right, the leverage from hedge funds, the dark blue line, is still far from what it was in the 1990s, but it has been going up since the beginning of the pandemic, since early 2020, and there's lots of leverage there. And this is what can happen when a hedge fund is very levered, and its bets go wrong. So it needs to sell very quickly, and it can cause shock waves in the markets. So Mrs. Elizabeth Warren from the Senate, of course, is unloading on this, and it has all the makings of a dangerous situation. So expect regulators to put their nose in this situation and to have more regulation on bank to make sure we have a stable financial sector. So more to come on that, but there should be some political consequences for what happened there. Uh, Interest rates have been rising strongly since the beginning of the year. I've mentioned that. So what we did is that we got the 2013 roadmap here, and we're looking at 2013 because it was a year where interest rates started rising pretty quickly. And so we look at what happened to the stock market while rates were rising and after. So the good news is that 2013 was very positive for the stock market. We don't think we'll have a year as strong as 2013, but we should have a positive year for the stock market. What led the way was discretionary, industrials, and financials, so more value sectors. And technology, as you can see, was below the S&P 500, so it underperformed the index, but it was still doing well, still having some positive returns. So what we mentioned the last few weeks, that technology suffering, that doesn't mean that it will be posting negative returns. That just means that it could be lagging other sectors in the index instead of leading like it has in the past. But if we have stronger rates and we have more inflation, well then what we want in a portfolio is to have on the left higher rates, financials first, industrials, and communication services. On the right, if you have stronger inflation, it's energy, it's materials, tech is still there. So that looks a lot again like the TSX, like Europe and Asia, like emerging markets. You want to be exposed to value, cyclical sectors. So that's why, once again, another argument why we prefer to be invested outside of the US in 2021. So underweight US, overweight elsewhere in the world, to be more value oriented rather than growth oriented. Finally, just to add some more arguments on financials, in the US, the banks are starting to break out. So that's a very positive development. It might be an emerging trend. On the left, you have a chart here. It's the rolling 3-year price returns of the financial sector in the US minus the 3-year rolling return of the S&P 500. So when it's above zero, that means that banks have been outperforming the last 3 years, and when it's below, that means bank have underperformed in the last 3 years. So what you can see here is that in the last 3 years to today, the banks have underperformed the S&P 500 by 25% total. So there's lots of room to catch up here. It's pretty cheap compared to the index, so we think there's some value in there. And on the right, as you can see, it's starting to break out now for the first time since 2007. So we just passed the peak of 2007. So it took 14 years, 13, 14 years to get back there. But when usually you have a breakout like that, it's a trend. It's something that's worth following. So we're already in that trend for many years, in that trade for many years. But when you have a confirmation of a trend like that, always worth paying attention. So what to watch next week in Canada, we'll look at the employment report, net change in employment. We had 259,000 jobs added in February, very strong. So we'll see if the pace continues. We'll look at the unemployment rate. In the US, we also have the jobs figures, but they are not technically next week. They are tomorrow on Friday. Markets are closed, but we still have this very important data. So I'll be discussing that next week. And we'll also have the ISM services index and the trade balance to look at. So that wraps it up for the week. ia.ca, your go-to webpage if you want to stay informed. You can subscribe to our newsletter on the top left of the page if you haven't done so already. If you want a copy of this presentation in PDF, economics at ia.ca. Sorry, I'm confused about all of these email addresses. So economics at ia.ca, and I'll send it to you. So thank you for your trust. It's always a pleasure just to keep you informed. We wish you a very happy Easter, and we'll be back again next week with another edition of the Weekly Economic Review.